So these things are all phased, which is why you tend to see after these inflationary bursts, I'm going to say something that might shock people.
US stocks dipped on Monday as the major indexes struggled to maintain the momentum from their surge from the previous week. The Dow Jones Industrial Average rose barely beyond break even, while the S&P 500 moved up to just 0.1%. Both benchmarks alternated between gains and losses. The Nasdaq Composite decreased by around 0.3%. The actions come after a dramatic recovery on Friday when the S&P 500 rose 3% during the session and nearly 6% for the week overall, marking its second best week of the year and its first weekly increase since late May. However, the benchmark index is on track to have its worst first half since 1970. Macro investor Raoul says that in fact the economy is broken. With the recessionary indicators, along with increased interest rates, we're on the verge of an economic meltdown. Let's listen to Raoul as he gives us his take on exactly why this happened and what he sees in the months to come. Don't forget to like and subscribe if you enjoy the content we do here on this channel. Let's get right into the video.
This affects crypto too. And if I look at the global money supply year on year against the year-on-year rate of change of Bitcoin, you can see it's a dominant driving factor of the overall direction. It is not the only factor, but a dominant driving factor. Now, global money supply has been shrinking because everybody's been tightening. So that has reduced the price of Bitcoin. So that was the crypto winter was essentially in that chart. The following chart shows that the money supply is cyclical too, and the ISM leads it by 9 months. And the ISM inverted suggests that the M2 rate of change is going to start rising again. So that basically tells us things like Bitcoin and risk assets, which ties into the NASDAQ being cheap and the exponential aid stocks being relatively cheap. There is a potential big turning point in markets to come. What I'm waiting for is that turn in bond yields.
Mm.
I think yields are forming a head and shoulders top with 265 in the 10 years, 275 in the 10 years as the neckline. If it breaks that, then we're going back below 2%. Inflation break-evens are already falling. So we've seen them fall sharply. And I'm expecting the oil market to show more liquidation. We saw a bit glimpse of that this week where we had some really rough days in oil. And I know there's a lot of oil bulls out there, and I understand the longer term picture. And Dwight Anderson made this clear in his interview is the thing that will pause the longer term picture is a demand destruction. And Warren talks about it as well. I think we are going to see more demand destruction in a shorter, sharper period of time. Then maybe oil steadies again back at $80 to $100 range, but the rate of change won't be as high. It won't keep going up at 100% increments, which means inflation is not as high. So the inflation we get out of this after this recession is going to be much less than people are expecting. People are over extrapolating past prices and rate of change than current prices. So that's basically my macro view, is maybe a bit more pain to take, really unclear. One gush lower, but the thing that will happen is that we need to brace ourselves for the economic impact. It's going to start to become clear to people, clearer than it is. People don't yet believe that story, but I think it's going to become very clear.
Raoul goes on to talk about the demographic demand shock and why the pain of monetary tightening is already in the market. He talks about there being a lot of possibilities, but not many probabilities when it comes to pricing in the other side of a recession, when things start to loosen.
The question in people's minds are, can we get the 70s again where inflation came down and then it came back up again? Well, for that to happen, that was a demographic demand shock. We don't have that this time. Could we have another supply shock? Could China be a big problem? Yes. But we're going to have to move the oil price to 200, 300 to have the same magnitude of price increases with the year-on-year comps. That's a really tough call to say that that's the most likely outcome. But again, there's lots of possibilities out there, not as many probabilities. The financial conditions are priced in an ISM of 35. So the pain of tightening is already in the market. So the probability is that the other side of a recession where conditions loosen is the thing that eventually gets priced in. Now, crypto markets, and I showed that with that M2 chart, have priced in this full thing. So it's already there. Again, the Fed are a kind of noise because it's the actual bond market that does the tightening, not the Fed. So the Fed, wherever they are in rates, is irrelevant because the bond market, pushed it all the way up to 3.6% or whatever it did in 10-year rates, and same at the front end. So I think it's a lot of the bad news, however much that is, whether it's 80%, 90% or 100% is in the price. And Sam sees that from the market clearing itself within crypto. How many of the bad positions have been washed out now as we've seen this kind of long-term capital management style blow up where everybody was lending to the same counterpart. And then when the counterpart goes under, everybody goes under. And I've lived through that before. Yes, normally these things are towards the end. I don't know yet whether we've seen the low. I think so. And I've been averaging it in aggressively, actually. The kind of biggest addition to my crypto bets since 2020 into this. But I don't know where the low is. Could a drop in economic conditions cause further short selling or panic? Possibly. I think the low is close. Whether it's in or not, I can't tell. But I know from all of my economic work, and I've probably got maybe 200 charts to back up all of the stuff I showed that suggest the balance of probabilities are that a lot of this has been priced, that we've got the inflation problem is probably a thing of the past, and that economic growth is going to fall sharply. Now, what happens when economic growth falls sharply is we now have this Pavlovian instinct of the market looking forwards and saying the Fed are going to pause and monetary conditions are going to ease. Now, don't forget that financial conditions index that I showed you, the global macro investor one. Well, that prices in commodity prices and the dollar and yields. So if yields start coming lower, commodities start coming lower, and the dollar eventually tops out, which it's not clear that that's going to happen yet, but at some point it will, then you've got all of those reversing. And that tells you that usually that's when the Fed have started reversing course as well. Now, there is another scenario that is very real. And the scenario is that I'm wrong, that the 1974 short, sharp contraction of the economy and contraction of markets is not that it's 2001-2 or 2008 all over again. In which case, you get a false rally that goes on for a period of time, and then it rolls over and has another whole set of lows. Those are the 50% sell-off style scenarios. I don't see that in the forward-looking data because I think it looks sharper and shorter than people expect, but that is a possibility. So it's really hard to call in these things, trying to pick lows and stuff is not easy because, many people got carried out in 2002. I remember it really well. Then 9/11 hit and then the whole thing rolled over again and it destroyed people. So, these kind of markets are not easy to trade.
The Federal Open Market Committee unanimously opted to raise the target range for the federal funds rate from 1.5% to 1.75%, with more rate hikes appearing imminent in response to the greatest level of inflation in more than 40 years. The Federal Reserve has once again turned up the heat. The 75 basis point increase is the biggest since 1994 and comes after a 50 basis point increase in May of 2022 that was already aggressive. Raoul is confident in the Fed's intention to raise interest rates in order to combat the 40-year high inflation and its effects on bonds, stocks, and the stock market. Now that the financial crisis of 2008 is past, the Federal Reserve expects its policy rate to remain around 2.5% over the long term. The timing of a recession and what the Fed will need to do to prevent the economy from entering a depression will be something we'll be keeping an eye on. What do you think about Raoul Pal's economic outlook for this year? Comment down below. Don't forget to like and subscribe. This is Library of Wealth. We'll see you in the next video.